All right, if you're a software executive or an investor, there's a huge strategic shift happening right now that you absolutely need to have on your radar. It's called embedded finance. And today, we're going to break down what it is, why it's creating so much value, and why it's probably the next big evolution for your software. Let's just get right to it. In boardrooms all over the world, the debate is pretty much over. People aren't asking if they should do embedded finance anymore. The data's in, the model's been proven. The only real question left on the table is, how do we pull this off? How do we execute? And here's exactly why that conversation has shifted. I mean, look at this number. According to Andreessen Horowitz, when you embed financial services into your software, you can generate 2 to 5 times the revenue of your software subscriptions alone. This isn't just a little boost, it's a completely different business model. And the scale of this whole thing, it's just massive. We're talking about a market that's projected to hit almost $700 billion by 2030. So let's be clear, this is not some niche trend. This is the future of how software gets monetized. Okay, so what are we really talking about when we say embedded finance? It's become a bit of a buzzword, so let's cut through the noise and get a simple, clear definition. At its core, it's really simple. It's about bringing financial tools directly to where your customers are already working. So instead of making them jump out of your app to process a payment or get a loan, you build that service right into their daily workflow. It becomes seamless, it becomes natural. Toast is the absolute poster child for this. They started out as software to help manage a restaurant, but today, a jaw-dropping 70 to 85% of their revenue comes from their fintech solutions. They didn't just add a new button, they transformed their tool into the financial engine that runs their customers' entire business. And this isn't just for restaurants. Look at a company like ServiceTitan. They serve plumbers, electricians, the trades. They embedded payments right into their app for technicians in the field, and by doing that, they solved a huge nagging problem, collecting cash and checks. It was a game changer that drove their growth and proved that pretty much any software that owns a key workflow can become a fintech company. So what's the actual payoff here? We see the revenue numbers, but let's dig into the strategic reasons why every investor and CEO in the software world is paying such close attention to this. It really boils down to 3 core pillars, 3 things that create incredible value and directly move the needle on the metrics that matter most, keeping your customers, making more money, and of course, your company's valuation. Okay, look at this data from William Blair. Platforms with embedded finance have a median net revenue retention of 111%. For software-only companies, it's 105%. Now, that might not sound like a huge jump, but what it means is your platform becomes incredibly sticky. When your software also runs their payroll and payments, the cost and hassle of switching to a competitor goes way, way up. And it also drives incredible efficiency. Think about it. Once a customer is using your software, that financial services revenue flows to your bottom line with really high margins. The data shows this leads to a way better Rule of 40 score, jumping from a median of 44% up to 53%. You're growing faster, and you're more profitable. It's the best of both worlds. And here's the ultimate payoff, the thing everyone really cares about. The market rewards this strategy with a higher valuation, plain and simple. Companies with embedded finance trade at a median of 10.3 times revenue, while their software-only peers are at 8.4. That premium is real, and it's consistent. Now, of course, seeing the opportunity is the easy part. Actually capturing it, that's a whole other story. This is not a simple project, but it can be broken down into a few key decisions that leadership has to get right. And that leads to the obvious question, right? If this is such a home run, why isn't every single software company on the planet already doing it? Well, it turns out the rewards are big because the challenges are real. This is not just flipping a switch. Success really comes down to nailing 3 things. First, you have to pick the right partners. The fintech enabler, the sponsor bank, this choice is absolutely critical. Get it wrong and you're in for a world of pain. Second, you've got to master compliance. The web of regulations, security, and risk is no joke. And third, you can't just build it and expect customers to show up. You have to treat this like a major product launch with its own dedicated go-to-market plan to drive adoption. So all of this leads to a fundamental choice. A strategic choice about the future of your company. This isn't just about adding a new revenue stream. It's about defining what your platform is actually going to be in the years ahead. And the choice is becoming really clear, really stark. Without FinStack, your software is basically a database. It's a useful tool, sure, but it's just a tool. But when you add fintech, You become a true business operating system. You become the central, indispensable hub where your customers don't just do their work, they run their business. And really, this is what it all comes down to. In the future, the companies that win will be the ones that control both the workflow and the wallet. If you only control one, you risk just becoming a feature for someone else who controls both. So the final question for your leadership team isn't whether you can afford to do this, it's whether you can afford not to.